It's a great pleasure to be here with you. This is the first of a series of launches of the book, and I think it's very appropriate that I'm doing that here at Imperial College. Imperial College means intelligent business, and we're trying to bring more intelligence to financial regulation. Financial regulators have dropped their compass. They've lost their way. And what we're trying to do with this book is to help them onto a better path. I won't say the right path. I'm sure there's more than one right path, but at least a better path than they're on today, and maybe to better complete their journey. In talking about how financial regulation can be better than it is, in talking about how we can reinvent financial regulation, we are inevitably going to end up criticizing existing regulation. And so I do want to begin by saying that I recognize how difficult the job is for financial regulators, financial policymakers. I think that, in fact, their job is more difficult. The pressures they face more complex and subtle than many appreciate. So whilst you'll hear a lot from me of where they went wrong, this isn't out of any sense of arrogance that they didn't have a very difficult job. And whilst they may have failed, it was a failing at doing something that is exceedingly difficult. And indeed, it is so difficult that there isn't one solution to financial regulation. In the 30 minutes or so that I want to speak to you, I'm going to focus on what I think is the main challenge that financial regulation faces, and a solution to that challenge. But there are a great many things that will be required to get right, to line up, to make financial regulation work that we won't have the time to speak to. Hopefully maybe some of those issues will come out in your questions, but things of bankers' pay, things of who should regulate finance. Is it the central bank? Is it a separate institution? Is it international? Is it local? To what extent should we use the courts to do financial regulation? Lock them up and throw the keys away. These are issues that maybe you want to touch on and we can focus on in the question session, but I'm not going to have time to discuss all of those things. It's a complicated subject, and there isn't one instrument that's going to be the answer to our problems. One of the reasons why financial regulation is so complex is that it is deeply political. Makes sense. Finance is about money, money is about power, power is political. And the troubling thing about financial regulation is that the political cycle coincides with the financial cycle, which coincides with financial regulation. These things are mutually reinforcing many of the problems that we face. Today, for example, in the shadow of a great financial crisis, there is tremendous interest in regulation. The regulators may be in danger of overreaching. It is not hard for them to convince people that we need more regulation. And it may well be that over time is seen to be restricting opportunities and risk takers, and we can discuss that later. And over time, what tends to happen is there is a cycle to financial regulation. Over time, as economies grow and banks become more profitable, they begin to flex their muscles and say, this regulation is holding us back, holding the economy back. And as the boom begins to grow, at the same time there is greater liberalization, and finance becomes bigger, and these things are initially good, and later they lead to a boom, which ultimately leads to a bust, and the cycle goes on and on. So one of the challenges we have in reinventing financial regulation is remembering the political context and thinking, how do we achieve these things given the politics of the day? Much of what we have in financial regulation is the result of political trends. I would argue that somewhat miraculously, and I spent a lot of time, those of you who may have seen some of my work, I will know that I've spent a lot of time criticizing the development of the Basel II regulations. And so I am happy to say that after the financial crisis, the Basel II regulators were quick at identifying mistakes they had made. How many people are quick at identifying mistakes they made? They were quick at identifying mistakes they made, they suggested some solutions, but then the politics took over. Because when you start bailing out banks with trillions of dollars and therefore have to cut back on your social programs, you could imagine the morality of this, the disgust of this. And so regulation became increasingly politicized. And so we see politicians today, Elizabeth Warren in the States, Bernie Sanders saying that if only we'd locked up the bankers after the crisis, everything would be solved. I won't argue that some people shouldn't be locked up, but I'm going to argue that however satisfying that may be, it's not going to stop the next financial crisis. Locking them up is not going to work, and I'm going to explain why. But part of the problem is that financial crises are not caused by a small number of people doing secretive things. It's caused by too many people doing something very common. All of these crises are associated with too much borrowing, too much lending by ordinary people. Bank balance sheets explode. It's not a connivance of the few, it's a connivance of the many. We're all involved. And that's something that the courts will find very hard to disentangle. You know, I sometimes think that if you look at some of the recent regulation, it was designed to, after the overexpansion of the Royal Bank of Scotland and the excessive zeal, one might say the recklessness of Sir Fred who ran RBS. But the point is that, you know, the guy gets knighted because at the time people thought this was good. This was right. It was making British finance bigger and stronger and more international. Very hard for the courts to really disentangle those kinds of problems. Now, if we start with a clean piece of paper and think about how financial regulation, how would you develop it if it's a clean piece of paper? Because one of the problems about financial regulation, you know, is it grows on what was already there. And it's like building a Lego brick empire. And if the foundations are weak, it's hard really to make that building much better. But it grows over time. Let's imagine we've cleared away the building. We've got a clean piece of paper. Let's begin with a few things that we know. And the first thing that we know is that incentives matter. It is convenient to think that a financial crisis was caused by a lot of people doing unethical, immoral things. And certainly there were those doing that. But at the end of the day, nothing that happened was not incentivized to happen, in fact, by our own regulations. There was excessive lending to mortgages. Mortgages uniquely under financial regulation had one of the lowest capital charges because the regulators wanted to encourage people owning a home. Banks took on too much liquidity risk and got rid of their credit risk, in part because we didn't charge banks for taking on liquidity risk. We only worried about their credit risk. So they got rid of credit risk and they took on liquidity risk. Much of what happened occurred because it was incentivized to take place. We've got to, if we want to change behavior, if we want to change the financial system, make it more resilient, more robust, we've got to change the incentives. If we lock away a few and don't change the incentives, nothing is really going to change. And the second key thing that we learn is that banks don't actually fail because they did things they knew were risky. You know, one of the common ideas, the common paradigms, is that, you know, what happened was there was a bunch of bankers in white coats pulling out of their top pocket smoking toxic weapons of mass destruction. And they threw this into the crowd of bewildered and innocent consumers. And then they ran away. The problem is that what happened is that these bankers pulled out of their top pocket these smoking toxic weapons of mass destruction, threw them into the crowd of bewildered innocent consumers, and then ran towards them. They couldn't get enough of this stuff, which they kept on stuffing in their pockets, or their back pockets and their front pockets. Banks fell down because of doing too much of things they thought were safe. The things they thought were risky, they put up capital against. If any of you have ever been a risky borrower of a bank, you know how hard it is to get a loan. Not only do they ask you for a collateral, for your parents to guarantee the loan, for you to put up all interest, if the interest, a year's interest and a special deposit, they make sure that loan is no longer risky. The problem is, it's the safe stuff that goes wrong. That's the fundamental problem of finance. It's not that the risky stuff proves risky, it's that the safe stuff turns risky. And that is the fundamental challenge of the current philosophy of financial regulation, which is called risk sensitivity. Risk sensitivity sounds so sensible that few people scrutinize it. Well, of course we must be sensitive to risk. The problem is that risk sensitivity means that we're sensitive to things we think are risky. So a traditional bank has to put up lots of capital using risk sensitivity against the loans that are risky. And it puts up very little capital against the loans they think are safe. But then it's the safe loans turn risky, they find they haven't got capital. That's our fundamental problem. That is why the banks that failed are the same banks that 2 years previously were considered to have the greatest amount of capital, an unprecedented amount of capital. And so that's the problem we need to solve. How do you make a financial system robust to a situation where safe things become risky? And therefore, dialing your capital based on what you think is currently risky is not going to save you. So we need to develop and reinvent financial regulation that is immune to you getting the risks wrong. Because that is the problem we keep on making. You could call it, we misestimate risk. If you look at all the financial crises, the things that are failing are things that there was a very good reason of why they were safe, why they were good. Whether it was mortgages and the financial engineers, hopefully none from Imperial College, financial engineers said, well, you know, these mortgages, if they're diversified enough, they're diversified across geographies, they're safe. Therefore, you can lend even more than you were going to lend to before. It's how do you make a system safe to the idea that we get risks wrong, we estimate them wrong. So anything that's based on a statistical measure of risk is not going to succeed. We have to move from statistics. We have to move from statistics to structural measures of risk. Safety in the financial markets is not statistical. That's a very important idea, especially to say that here at a school which has one of the most excellent reputations in mathematics and statistics. I once taught a course as a director of the Global Association of Risk Professionals to risk managers, and it was called Risk Management Without Numbers. It was, how do you manage risk if you had no numbers? Because you know what? We didn't have numbers 50 years ago, but there was risk management. So we need a structural, not a statistical way of thinking about risk. And I want to introduce to you a brand new concept. It's called risk capacity. And I'm going to say to you that we need a concept of risk capacity, not a concept of risk sensitivity. Now, what is risk capacity? In the heyday of the boom before the financial crisis, there's a tremendous amount of liquidity. The financial engineers are running riot, and there develops an idea that risk is something that we can extract from everything. We can slice it and dice it and move it around. It's like a dial. We can dial it up and we can dial it down. There's one thing called risk. And in a time, an episode of great liquidity, that looks correct. And people would say, you know, I've got this amount of risk, but I need more risk. Or I've got this amount of risk, I need less risk. I would dial it up, dial it down. And that's fundamentally the wrong way to think about risk. There isn't one risk. There isn't one risk where you could add up all these different risks together and say, that's my risk. Because each of these risks are different. Liquidity risk, credit risk, market risk are fundamentally different types of things. Adding them up together is meaningless. It's the same as adding up apples and oranges and lemons together and saying that, you know, they're all apples. They're different things. And the way you know they're different things is not because we've given them different names. They're different because if you were to hedge each risk, you'd have to hedge them totally differently. And that's what tells you that you can't add it up together. Now let's take liquidity risk. Liquidity risk is the risk, and a good example of that may be my house in southwest London, in Wandsworth. It's a glass and steel house. It would look perfect in California, except it's in Wandsworth. Now there is someone who would like to buy my house, but that person is not typical. So I run liquidity risk with that house. If I can wait long enough for that couple, that avant-garde couple from Berlin to visit London, I can sell the house at the price. But if I can't wait and I have to sell it tomorrow, I will take a big hit on that price. That is, that house, that's a liquidity risk. Now, what's the way to hedge liquidity risk? Is to have a 30-year mortgage. It's that you're not required to refund your house every day and hope that the bankers are happy every day about your house. Because there may be an episode where they're not and you can't sell it. Liquidity risk is hedged with time. Now let's think about credit risk. Credit risk is the risk that a credit blows up. That you've got a contract with General Motors, it's a 10-year contract, you wake up the next morning and General Motors no longer exists. You're running credit risk. Credit risk is a unique risk. It's the only risk that goes up the more time you have. So if you've got more time, you can hedge liquidity risk, but more time does not hedge credit risk. If I give you a General Motors bond and tell you give it back to me in a day, I've given you a gift. If I give you a General Motors bond and tell you you can't do anything with it for the next 50 years, that's a ticking time bomb. The more time you have, the more time there is for something to go wrong. Credit risk goes up with time. Market risk is a bit of a hybrid. Equities are market risks. The way you hedge, and the way you hedge credit risk, I didn't mention it, the way you hedge credit risk is not time. It's by diversifying across different types of assets with different correlations. Market risk is a hybrid. You need time, and you need diversification across assets. So we've got 3 different types of risk. And you know what? Different institutions have a different capacity for absorbing those risks. So if I am a bank and I've got 25,000 customers, bits of credit risk, I'm able to manage and diversify my credit risk. If I'm an insurance company who wants to put away my investment for 20 years to pay out that life insurance, and I don't want to actively manage it, I don't have a capacity for credit risk. This credit risk is going up with time, I'm not managing it. I have a capacity for liquidity risk. I have a capacity for owning California-style homes in Wandsworth because they may have problems for a year or 2, but over 20 years, I'll find a buyer. So different parts of the financial system have different capacities for risk, different capacities for different risks. We need to reinvent our financial system where the right places are taking the right risks. And then we can take more risks, but more safely. And how would we do that? Well, you could say that I have a similar regulation across all aspects of finance. Insurance, pension funds, investment funds, banks, and they're required to put up capital against every mismatch. The liquidity mismatch, the credit mismatch, the market risk match. And what that does, imagine you're an insurance company. You've got great capacity for taking liquidity risk. It encourages you to go to other people and say, I can take your liquidity risk. I've got a capacity for it. And it encourages you to say, well, here's a risk I don't have a capacity for. I want to sell it to other people. And so, in fact, you incentivize a system, remember, incentives matter, to take risk and move it to the place it can be best absorbed. And if I get my pricing wrong, I'm okay. If I've mispriced my illiquid house, I'm okay. I've got 20 years for it to come right. If I've mispriced my credit risk, I'm okay. I'm diversifying it across 25,000 other credits. So here is a financial system that will absorb risk, push risk in the right place, and is not dependent on me estimating risk correctly. And it's another important point, which is that risk is about behavior. Risk is not inherent. When Harry Markowitz was at the Rand Corporation in 1954, working with Danzig, and they have, if you like, one of the first big supercomputers, and they're using the first collected bits of data on markets, and they discover that there's a risk-return trade-off. The higher the volatility of prices, the higher the risk, the higher the return. To them, the only ones seeing it, the first ones seeing it, risk was probably inherent. Move yourself 55 years forward. Everyone's got the data. Everyone's got the models. You see risk and you see a risk-return mismatch, you dive into it. Suddenly, risk is no longer inherent in instruments. It's about behavior. A good example of this is that regulators have said people must have more safety, they must have more collateral, and they have defined what is safe. They have in their wisdom decided that sovereign government bonds are safe. And as a result today, $5 trillion of sovereign government bonds gives a 0 to negative yield. Are they safe? If anything, we have created a situation where they're overbought. Too many people are too long sovereign government bonds. Something goes wrong, there'll be a mass exit. We are forcing people into assets. They're actually, by forcing them into assets, we've turned the assets from being safe to being risky. A financial system is safe the least homogeneity you have, the greatest diversity you have, the most heterogeneity. And we need to worry about heterogeneity of behavior. Forcing everyone to do the same thing creates risks. Calling something safe makes it risky. Finance is often associated with physics, and I think that the connection is a little bit false. I think economics is too much associated with 18th and 19th century physics. The physics of things, of atoms being independent of each other. Not the physics of the 20th century, of relativity, of Heisenberg, of the idea that looking something changes it. That is what really finance is about. It's an interdependency where behavior creates the risk. And we have to be careful about what behavior we're encouraging with our financial regulation. Let me come back to this issue as I conclude with the observation that, we need to take risks. An economy that is not taking risks will be starved of economic growth, and this will grow a political malaise and actually may end up with even greater risks. So the Soviet Union, their banks didn't take a lot of risks. Did that actually make them safe? Or by making the economy fragile and vulnerable, did it not create big risks? And then we've got to be careful about taking too much risk. We've seen all too easily how too much risk-taking allows a few to glow brightly and then plunge the rest of us into darkness. We need a Goldilocks amount of risk-taking. Not too hot, not too cold, not too big, not too small. The right amount of risk-taking. But that doesn't require a monodimensional thinking about regulation. That regulation is like it's on a dial. We have more of it or less of it. Because it's so politicized today, that's the way our policymakers think about regulation. They look at it through the prism of politics, through this monodimension, where is it more or less you're asking me to do? And after the crisis, we had more. Today, we're having a little bit less. I think we need to look at it in a different way altogether. Our approach to risk and regulation is a little bit like this. You see risk, a regulator sees risk in a sector, and they don't like it. So they apply a regulation, a tax, and what that does is it pushes that risk from that sector to another sector. And when the other regulators observe this risk coming into their sector, they say, I don't like that. So they start to tax it, and it pushes it to another sector. Risk is not something you destroy that disappears in the ether. Risk invariably shifts rather than dissolves. And the logic of what we're doing is we keep on shifting risk until the next regulator doesn't like it. So we've shifted risk out of banks. We seem to be putting, in my view, risks into insurance companies, into money market funds, into pension funds. And we'll be shifting the risks out of those places to other places. The logical extension of our approach to risk is that we'll only be happy when we push risk to where we can no longer see it. And that isn't a good place for risk, ladies and gentlemen. So the best thing you want to do is not to try and ban risk, knowing it will only shift, but actually to draw risk in. To say, I want to see it. So I want to incentivize risk to go to the right places. Bring the risk out of the dark corners, where it's visible and bright, and you can see where it is and attach it to where it can be best absorbed. That's what we need to do with financial regulation. It requires a reinvention. It requires a focus on this new concept of risk capacity rather than risk sensitivity. And that's what my book, ladies and gentlemen, Reinventing Financial Regulation, a blueprint for overcoming systemic risk, is mainly about. Thank you very much indeed.